This is part 2 to chapter 1. The chapter 1 video got cut off at the last 2 slides, so I'm just going to start here and begin at the beginning of this slide. So we're talking here about corporate governance. So this is how a company is going to organize themselves as far as setting up rules, what the correct standard operating procedures should be, the laws by which the company is going to operate under, how they're going to be controlled, how they're going to be regulated. So the corporate governance is a process for the company to organize itself up in a set of rules on how they are going to be governed. Now, the responsibilities, who is responsible for doing this? Well, it's going to be the participants, the shareholders, the board of directors, the officers and the managers, and other stakeholders will all have a responsibility of participating in either developing or commenting on this corporate governance. So a well-defined corporate governance is going to be some sort of structure that's going to benefit the corporate stakeholders. So it's going to focus on the company is going to do the right thing by shareholders to maximize profits in a fashion that's going to be compliant with governmental and corporate regulations so that the company is not going to be engaging in illegal activity, and the members of the company, all the stakeholders and employees and shareholders are also going to be following these rules to make it fair and reasonable. And there's going to be both external and internal forces that are going to influence the government, the corporate governance of a company. So the internal influencers are going to be, the shareholders who are going to vote on the board of directors, who are going to have influence on how the firm is governed, and so the board of directors are going to hire the VPs and the top managers. So they're going to want to make sure that internally there's mechanisms in place to ensure that the company is going to act accordingly to what the shareholders want. And it's also important that the company has in place a way to make sure that the laws and regulations, that, especially for U.S. companies, are going to be followed correctly, especially after a number of scandals that took place involving corporate governance. Now, internal corporate governance, this is a set of tools or mechanisms that are going to establish the firm's corporate policies, which is going to be something that the board of directors is going to work with. So the board is going to be responsible for hiring the CEO and top managers for the company and setting the terms of compensation for these people. And so the primary way in which the boards are going to try to align the interests of the managers and the shareholders is to make a structure where management is going to be compensated for doing the right thing and maximizing shareholders' wealth. So you want to make sure that your senior employees consist of, one, a fixed base salary in combination with some kind of variable component that's going to reward them for performance. So they're encouraged to do what's best for the company, and they have their own personal stakes. That the company succeeds, they succeed. And this could be something such as giving these people stock in the company, giving them stock options. So stock options is one way that we can grant these people ownership or stock in the company. So if the company succeeds, the share price goes up, and then they do well because of that. So stock options is one particular way to align the interests of the managers with the interests of the shareholders, since they both have an ownership stake in the company. Now, some companies have something that's called restrictive stock. So a company may link, or connect the pay of senior managers to the performance of the company stock in some other ways. So firms can reward senior manager by giving them what's called a restrictive stock, where the shares do not fully transfer from the company to the employees or the management until certain conditions are met. And those conditions could be anything, but usually they're related to length of service, performance of the company. And when this restrictive stock is fully, what they say is called vested, means that you've met the conditions, then the ownership of the shares will transfer to the employee. So it's sort of like, we're going to give you 5,000 shares of stock, but first you have to work here for 5 years continuously, and you have to increase the overall share price by 50% within that time. And if you meet those two goals, then this stock will become yours. So we don't give them stock right off the bat, but we set these restrictions on it until they can actually get that stock. Okay, so now moving into our last slide here, we're going to talk about external corporate government mechanism. So we talked about the internal in the last slide. Now the external, this is going to be, so the board of directors does not effectively monitor senior management and establish a ground. They don't decide everything. So there's only so much the board of directors to do. Now, there are external influences that can fill this void between what the board can do for governance and what they're not able to do. So they can't really do everything. Now, so investors may exert an effect on senior management on their own way, making their own voice known. Also, investors, which, they can bring about change because they can vote on their shares as well. So they can, if enough of these investors get together, they don't like what the company or the board is doing, they can pursue a takeover, which they can remove board members and remove employees. Also, governments as an external, government regulations can impose some standards in corporate governance, some regulations for the minimums of corporate governance. So you do have some external influences outside the board. You can have individual shareholders, or what we call activist investors, who Carl Icahn is one of them, that can come in and organize a takeover or a threat to have management rethink things and change policy. Now, we do have individual investors, but we have much larger institutional investors. So these institutional investors are going to have a bigger say in shaping the corporate governance. So institutional investors who may own 5, 10, 20% of the shares of a company, they're going to be able to have a bigger influence because they have a bigger say or bigger amount of votes than individual investors. That's why if you collect enough individuals together, you can make a pool of stock big enough to threaten the company. So as far as activist investors, these are going to be some big, very influential, wealthy people who have a lot of money that can go in and start buying shares of the stock, assembling a team of current shareholders, get a significant position in the stock, so then they can start making demands, persuading senior management to take action. Basically almost bypassing the board or forcing themselves to be elected to the board so they can have a bigger stake or control on the company. And if a company is underperforming or shareholders feel that the company is not doing what's in their best interest, they'll be more likely to go along with this activist investor. And this has happened. This isn't, an isolated occurrence. This has happened plenty of times with many companies. So the threat of a takeover is sometimes big enough to ensure that the manager of the company and the board of directors of the company are going to take notice of what the demands are and try to incorporate or appease them so the company doesn't get taken over so easily. Now, lastly, can be government regulation. So the government can get involved, so they can step in here and they can say, okay, there were a lot of shenanigans that happened in the late 1990s, early 2000s, where companies were doing a number of terrible things. So they passed the Soybeans Oxley Act of 2002 to help make companies more fair for shareholders. So government regulations, the government generally steps in pretty late and after a big problem has occurred, but they're going to jump in and say, okay, it's obvious that we're going to have to do something here to make the company, make the things a little bit more fair, how the company treats either the environment, shareholders, their business practices, So types of problems that companies have done in the past is false disclosures of financial reports and other materials. So they just issued fake information to investors. So you see how that's a problem. 2, undisclosed conflicts of interest between corporations, analysts, auditors, attorneys, corporate directors, officers, shareholders. So this is inappropriate, undisclosed conflicts of interest, meaning that the company wasn't doing what was best for its shareholders. They were more influenced by conflicts of interest between multiple parties associated with the company. So because all this bad stuff went on and stock prices crashed, the U.S. Congress passed the Sarbanes-Oxley Act in 2002, sometimes known as just SOX, SOX, and it was intended to eliminate many of the conflicts of interest problems that arose over the past 10 years, that are typically likely to arise in the corporate environment. So basically, corporate managers are not held personally accountable for the firm's financial decisions and disclosures. What the SOX did is accomplish the following. They established an oversight board to monitor the accounting industry, especially how companies are audited and the audit regulations and controls, because too many auditors and audit companies had side deals with these companies, and when they had a conflict of interest, the auditors would overlook certain bad practices of the company in order to maintain their business connections with them. Very bad, right? So they also toughened the penalties against executives who commit any type of fraud, any type of misleading accounting disclosures, any type of ethical issues, encouraging companies to come up with ethical guidelines for its officers, establishing corporate board structures and membership guidelines that were more fair to shareholders, establishing guidelines as far as how analysts can interact with companies and what would be considered conflicts of interest with analysts who rate and judge the value of the company's stock price. They also mandated instant disclosure of stock sales by corporate executives. So if executives were buying and selling the stock, everyday shareholders would know more concretely and conclusively what they were doing. So this was an important step to make companies a little bit more fair to individuals. Okay, so that is the end of Chapter 1. At this point, now that Chapter 1 is ended, you should think about completing the homework for Chapter 1 on the My Finance Lab, maybe reviewing the learning goals of this chapter, and just, if you have the time, reading over the textbook, Chapter 1 in the textbook as well, to reinforce a lot of what I said during this first chapter. I hope you enjoyed it, and I look forward to talking to you next time. Thank you.